Most people are somewhat familiar with the idea that you can make individual retirement arrangements, or IRAs, part of your retirement planning. But it's not always clear about the difference between a traditional and a Roth IRA. So let's start with the similarities. As of this recording in 2022, you're allowed to put up to $6,000 a year into your traditional or Roth. And if you're 50 years old or older, you can have an additional $1,000 as a catch-up provision. Where the difference comes in is primarily of how these two types of accounts are taxed. So with a traditional IRA, your money is taxed when it comes out, meaning when you need it for retirement. So you're deferring your taxes into a later time period, not eliminating them, but you're putting off the tax bill. That means you may be able to take a bit of a deduction now when you put the money into the account, although not a full dollar for dollar deduction off your income tax bill. With a Roth IRA, on the other hand, your money is taxed when it goes in. That means you pay the taxes today, but when you take them out at retirement, they will be tax-free, including any earnings in that account, which is one of the big reasons that people do like a Roth IRA. Now, unfortunately, it is subject to income phase-outs, so depending on the charts for that year, you may be phased out of being able to make a contribution into a Roth at all. Another positive on the Roth, on the other hand, is that they are not subject to what's called RMDs, or required minimum distributions. If you do like the idea of a Roth, but you're not in one now, you may want to roll over some of the funds that you currently have in other types of retirement accounts. So you could convert a traditional IRA into a Roth IRA. Now keep in mind, that will be treated as income, and therefore you will be taxed on that amount when you do the conversion. You will want to watch out to make sure you don't bump yourself up into a higher tax bracket when you do a conversion. But no one says you have to do it all at one time, so you may spread it out over a number of years in order to avoid bumping yourself up into a higher tax bracket. You may also have what's called a qualified plan from a prior employer. A qualified plan would be something like a 401k or a 403b or a 457. So again, you will have to go from a qualified plan into a traditional IRA before you can convert it into the Roth IRA. You can never just jump into a Roth, and that's because the IRS will give you the tax break on the back end in retirement, but you'll have to pay your tax bill now for the privilege.